Hi, I'm James. Welcome to Sketching Finance, where we simplify finance through visual storytelling. Welcome back to day 3 of your 90-day financial transformation. Yesterday, we felt the excitement of the 8th wonder of the world, compound interest. You saw how a small seed could grow into millions. But today, I have to play the villain. I'm going to pour a bucket of cold water on those millions. Because $1 million tomorrow won't buy what $1 million buys today. There is a silent thief in the room, and if you don't learn to outsmart him, your retirement dream will dissolve into smoke. This thief is inflation. He doesn't steal your bills, he steals what those bills can buy. Today, we aren't just looking at math, we are looking at survival. We will dismantle the money illusion, calculate your true purchasing power, and install a strategic defense to ensure that when you finally reach your goal, the money is actually worth something. Let's hunt the silent killer. Don't think of inflation as a complex macroeconomic term. Think of it simply. Your money is evaporating every single day. In the US, look at the cost of a new car. In 1995, the average price was about $15,500. Today, you're looking at over $47,000 for the same utility. The bill in your pocket looks the same, but the life it can purchase is shrinking. This is the decay of your labor. If you keep $100,000 in a safe for 20 years, the bills will stay crisp and green. But while the number remains 100,000, its purchasing power might drop by 50% or more. You haven't lost a single dollar, yet you've lost half of your wealth. This is why saving is the riskiest move you can make over the long term. You are keeping the paper, but losing the value. Let's use the Big Mac or pho rule. In 2005, a few dollars bought a full meal. By 2055, at a 4% average inflation rate, you might need $50 or $60 for that same simple meal. If your retirement plan assumes you can live on today's prices, you are heading toward a financial disaster. Inflation is a constant headwind, and your investment engine must be strong enough to fly against it. To stay in the same place, you have to move at the speed of inflation. To get ahead, you have to move faster. If you hold cash, you have dropped your oars and are letting the current pull you toward poverty. Every financial decision you make from this day forward must ask one question: does this outpace the current? Economist Irving Fisher popularized the term money illusion. It's a cognitive bias where our brains focus on the nominal value of money, the face value, rather than its real value. We get a hit of dopamine when we see our balance go from $100,000 to $110,000. But if prices also rose by 10%, you aren't any richer. You've been fooled by the numbers. Professional investors on Wall Street never celebrate nominal gains. They only care about real value. They strip away the inflation layer to see the bone. If you don't use this real value lens, you will fall into the trap of false satisfaction, believing you are winning the game while you are actually standing still or falling behind. This is the most important formula for day 3. Real rate equals nominal rate minus inflation. If your bank pays you 5% interest, but inflation is 4%, your real growth is only 1%. If you are in a high tax bracket after the government takes its cut, your real rate might actually be negative. You are effectively paying the bank to hold your money while it loses value. Let's compare. In scenario 1, you save at 6% with 4% inflation. Your real gain is 2%. It's incredibly slow growth. In scenario 2, you invest at 12%. Your real gain is 8%. That 8% is where true wealth is manufactured. Saving is just a temporary shelter. It is not a vehicle for growth. To build a legacy, you must target a nominal return of at least 10 to 12%. Remember Mr. A from yesterday? He had $300,000 after 30 years. It sounds like a fortune, but using the discounting formula, PV equals FV over by 1 plus I to the n, we see the truth. At 4% inflation, that $300K in 2055 only has the purchasing power of about 92.5K today. It's still a win, but it's not the super wealth he imagined. This is a wake-up call. When you look at your retirement spreadsheet, you must add a real value column. If your goal is to retire with $1 million in 30 years, you are actually planning to retire on a lifestyle of about $400,000 in today's money. If that's not enough to cover your dreams, you need to double your target right now. Most people avoid stocks because they are risky in the short term. The price jumps up and down. They choose savings because it's safe. But here is the risk paradox. Safety in the short term is the greatest danger in the long term. Over 20 years, cash is 100% guaranteed to lose value. It is the only asset with a certainty of loss. Real risk isn't market volatility. Real risk is running out of money before you run out of life. Short-term fluctuations are just noise. Long-term inflation is a silent, permanent erosion. A professional investor accepts short-term price swings as the price of admission for long-term purchasing power protection. Inflation doesn't hit every asset the same way. Some are victims and some are beneficiaries. Cash and fixed-rate bonds are victims. Their value is eaten away. But hard assets like real estate and stocks can be the turbine that turns the wind of inflation into energy. They have the ability to adjust their value as prices rise. A balanced portfolio for the U.S. market often targets 60% stocks and 20% real estate. Why? Because rents move with inflation and great companies raise their prices. You want to own the engines of the economy, not just the currency. By diversifying into assets that grow with the cost of living, you aren't just surviving, you are winning. Warren Buffett says the most important decision in evaluating a business is pricing power. If a company can raise its prices without losing customers to a competitor, it's a gold mine. Think of Apple or Coca-Cola. When their costs go up, they raise the price of an iPhone or a soda, and we keep buying. When you own companies with high pricing power, you own an inflation-proof shield. Their revenue increases, their dividends increase, and your wealth stays ahead of the curve. Don't just buy stocks. Buy businesses that the world cannot live without. These are the ultimate hunters of the silent killer. At Wall Street, we use stress tests. What if inflation isn't 3% or 4%? What if it's 7% like it was in 2022 or 15% like the 1970s? If you stress test your plan and a 7% inflation rate makes you go broke, your plan is too fragile. You need a plan B. Your plan B is your human capital. In a hyperinflationary world, your skills are the only thing that can't be devalued. If you are an expert in AI, data, or sales, you can always demand a higher wage to cover the cost of living. Investing in yourself is the ultimate inflation hedge because your brain is a portable, productive asset. The biggest fear for retirees in the US and Europe isn't the market crashing, it's longevity risk, the risk of outliving your money. If you retire at 65 and live to 95, that's 30 years of inflation. If you are too safe with your money, you might be comfortable at 70, but eating ramen noodles at 90. You must accept a certain level of volatility to guarantee sustainability. You need growth assets even in retirement. A 100% bond or cash portfolio is a death sentence for a 30-year retirement. You need the engine to keep running even after you stop working. To manage this, we use the bucket strategy, popularized by experts like Bill Bengen and his 4% rule. Bucket 1 is cash for the next 2 years. This is your sleep well fund. Bucket 2 is bonds for years 3 to 7. Bucket 3 is stocks for everything beyond 7 years. When the stock market drops, you don't panic sell. You know you have 7 years of cash and bonds to live on. This gives Bucket 3 time to recover and capture the long-term growth of the economy. This strategy turns volatility into a manageable variable rather than a source of fear. There is another thief, and this one lives inside your head: lifestyle inflation. As our income grows, we tend to upgrade our lives. We buy bigger houses, flashier cars, and $10 Wagyu burgers. This is called the hedonic treadmill. You are running faster, but you aren't moving any closer to freedom. To stop this creep, use the 50% rule. Every time you get a raise or a bonus, only allow yourself to spend 50% of the increase. The other 50% goes directly into your investment engine. You still get to enjoy your success, but you are fueling your future at the same time. This is the ultimate margin of safety for your retirement. The book, The Millionaire Next Door, shows that real millionaires in the US usually drive used cars and live in modest homes. They know that the enemy of wealth isn't the cost of living, it's the cost of showing off. Keeping your lifestyle stable while your income grows is the fastest way to accelerate your compounding. We have finished day 3. You now see the silent killer. You understand that safety is an illusion and that real value is the only metric that matters. Your homework. Stress test your Excel sheet with a 7% inflation rate. If the number looks scary, it's time to raise your goal. You have the mindset and the strategy. Tomorrow on day 4, we move to personal finance. I will show you how to find the money to invest even if you think you're broke. We will master the 50-30-20 rule. Subscribe and hit the bell. I'll see you on day 4.